VWRA is one of the most popular all-world ETFs. If you go online, you will see it being mentioned everywhere. VWRA, VWRA, VWRA. Many investors choose VWRA as their core holding because it is simple, globally diversified, and most importantly, it is Ireland domiciled, which helps to reduce dividend withholding tax and avoid US estate tax. But what if I told you that there's an even cheaper all-world ETF available, and that ETF is called ACWD? Just like VWRA, ACWD is globally diversified and Ireland domiciled. However, its expense ratio is only 0.12% as compared to 0.19% for VWRA. Cheap fees aside, ACWD is not identical to VWRA, and those differences can affect how the ETF behaves over time. In this video, I will go through what those differences are, how they may affect performance, whether switching from VWRA to ACWD actually makes sense, and lastly, I will also show you how you can buy it on IBKR. So first things first, the biggest difference between VWRA and ACWD is the index that they track. VWRA tracks the FTSE All World Index, whereas ACWD tracks the MSCI All Country World Index. On the surface, both indexes sound very similar, and in many ways, they are. Both aim to represent the global stock market, and both include companies from developed and emerging markets. The key difference lies in how much of the market each index chooses to cover. On one hand, the FTSE All World Index targets around 90 to 95% of global market value. This is why the FTSE All World Index holds more than 4,000 stocks. On the other hand, the MSCI All Country World Index takes a more selective approach. It targets about 85% of global market value. Because of this, the MSCI All Country World Index holds fewer stocks at around 2,500. However, even though ACWD holds fewer stocks, the most important holdings at the top are largely the same. For example, the top 10 holdings of both ETFs are almost identical. The main difference is that ACWD's top holdings carry slightly higher weightage, since the ETF spreads its exposure across fewer companies overall. Likewise, both ETFs have very similar country allocations, although ACWD is slightly more concentrated in the United States. A similar difference shows up in sector exposure as well, with ACWD having slightly higher allocation to the technology sector as compared to VWRA. So, while the indexes are not identical, they are effectively tracking the same global markets. So, think of them like McDonald's versus Burger King. They look different, but they are basically the same thing. This brings us to the more important question: which ETF actually delivers the better performance? Over the past 5 years, both ETFs delivered almost identical returns. In fact, the difference is so small that you will barely notice it on the chart. Okay, VWRA technically outperformed ACWD by about 0.21%, but let's be real, that difference is C-base small. But then, what about the liquidity? On one hand, ACWD has an average trading volume of about 34,000 units. On the other hand, VWRA average volume is much higher at 118,000 units. So how does that affect the bid-ask spread? At the time of testing, ACWD bid-ask spread is around 7 cents, whereas VWRA bid-ask spread is around 6 cents. So practically, no difference between the two. What this means is that given that ACWD is practically the same as VWRA, but much lower expense ratio of 0.12%, ACWD is clearly the better ETF here. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. So, how much can you actually save by switching over? Let's assume you invest $1,000 every month for 40 years, and the portfolio grows at an average rate of 8% a year. Under this scenario, choosing ACWD instead of VWRA would save you about $58,000 in fees. Wholesale. That is roughly the cost of one HDB toilet today. So, does that mean you should switch? Obviously, if you have not started investing in VWRA yet, the answer is simple. You should just start with ACWD. Lower fees are always better when everything else is equal. But what if you have already been investing in VWRA for some time? In that case, switching your existing holdings may not be necessary. Even though $58,000 sounds significant, it is important to remember that this amount is spread out over 40 years. During such a long period, many things can change. For example, back in 2025, when GUARD lowered the expense ratio of VWRA from 0.22% to 0.19%. On the other hand, State Street Global Advisors also reduced the fees for ACWI in 2024, cutting it from 0.4% to 0.12%. And in the future, as the fund grows and attracts more assets, it is entirely possible that the fees could be reduced again. Because of this, if you constantly switch ETFs each time a slightly cheaper option appears, you will end up switching funds over and over again, which may create unnecessary work and potential costs. So while choosing a low-cost ETF is important, what matters more in the long run is sticking to a clear strategy and staying invested. But with that being said, if you do decide to invest in ACWI, here's how you can find it in Interactive Brokers. First, tap on the search icon on the top right hand side and search for ACWI. You will see several results. The one that you want is labeled LSE ETF, which stands for London Stock Exchange. This is the exchange where ACWI is listed. Once you select it, tap on the buy button, enter your order details, review them, and submit your trade. And that's it. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every week.